estate planning, and 3 crucial tax issues, what you need to know. So really dividing this into 3 areas of discussion. One is capital gains taxes, and most importantly, how you can avoid them. Property taxes and Prop 19. If you follow us, you know we talk about this a lot. We're of course going to talk about estate and gift taxes in the coming clip, what you need to know there. And of course, action items that you can take. Capital gains taxes. Mistakes can cost your family hundreds of thousands of dollars. What are capital gains taxes and how do they work?
You only have a capital gains tax if you sell an asset. You buy a share of stock for $10. That's the cost basis. Let's say you're lucky, you sell it for $100. You have a $90 profit or capital gain, and you have to pay capital gains tax on that. Now, that assumes that you've held it a year. If you sell it in less than a year, it's regular income tax. So that's not advantageous. So significant tax on the gain. If you bought your home for $100,000 many years ago, as a lot of older folks around here did so, now you sell it for $2 million, you have a $1.9 million capital gain. Enormous capital gains tax exposure. So we have to be wary of this when we're doing our long-term planning. Unless you plan, you could lose 30% of the value of an asset that you sell.
We are going to talk about 4 key concepts today. The concept of the stepped up basis.
The cost basis is the price that you paid for an asset. If you sell it while you're living, you have this capital gains tax exposure, which can be devastating. First key point about this basis idea is that the basis enjoys what's called a step up at your passing. So if an asset is in your estate as your separate property or as community property for husband and wife, every asset in your community property trust gets this stepped up basis. So I gave that example of the share of stock that went up to $100 in value. At the time of the first death, doesn't matter what was paid. The new basis reflects the market value on the date of death, $100. If that stock is then sold for $100, subtract the new basis of $100, zero gain, zero tax. At the second death, if the trust is properly structured, there's going to be another, if there's a husband and wife situation, there'll be a second stepped up basis. So again, wiping out capital gains tax exposure. If an asset is not in your estate at the time of your passing, doesn't get a stepped up basis. So structure of your trust matters in this context of capital gains tax avoidance.
Let's go through 3 tips. So the first tip, if you're single and you've lived in your home at least 2 of the last 5 years, you can only have 1 residence, the first $250,000 in gain is tax-free. So if you bought a house for $500,000, you sell it 2 years later, you lived in it for those 2 years for $750,000, you don't have to pay any capital gains taxes on that. If there are 2 people, a married couple on title for that house, and they both lived there for 2 of the last 5 years, you can double that protection to $500,000. You could sell that, you buy a house for $500,000, you could sell it for $1 million, and you wouldn't have to pay a penny of capital gains taxes, again, as long as it's the residence. So you kind of have some choice as to which property is your primary residence. If you have more than one, maybe you move into one for a while and make it your primary residence. If you have rented a property out, we'll talk about what you can do for rentals, but maybe it makes sense to move back in before you sell it, or there's different things you can do. So $250,000 if you're single, $500,000 if you're a married couple, and if you've lived in a house for more than 2 years. So let's talk about if you have a rental property. Let's say that you have a fourplex and you're really sick of managing it. You don't want to deal with tenants anymore. You want to sell it. Well, if you just sell a rental property there, you don't get that $250,000 exemption. So if you sell it for more than you paid, you have to pay capital gains taxes. But if you do a 1031 exchange, this is in the IRS tax code, or a like-kind exchange. If you sell an income property and follow the right steps, you have to start this process before you sell. Then if you buy another like-kind investment, another rental property or rental property investment, you don't have to pay any capital gains taxes. You can roll over your cost basis from one real estate investment to another. Let's say you have a fourplex that's worth $2 million. I know that's a big price, and you don't want to manage it anymore. You want to sell it. Well, you just sell it, and you bought it for $100,000 decades ago. Oh, hundreds of thousands in capital gains taxes. If you do a 1031 exchange, you could take all 2 million of that and put it into another real estate investment that qualifies it. It doesn't have to be a building, by the way. There are special Delaware statutory trusts. There are passive investments that are actually structured to work for a 1031 exchange. But if you put it into another real estate investment that qualifies, you pay 0 capital gains taxes. And so there's a way, for example, to take money from an actively managed pain in the butt property to a passively managed where you don't have to lift a finger anymore. And yeah, you might pay some fees, but then you might just get income from that. And rather than taking this huge capital gains tax hit, that full $2 million can go to work in this new investment for you, kicking off income. That new investment, if you ever sell it, would have a huge capital gains tax hit. But if you keep doing 1031 exchanges, we have many clients who've done these. If you keep it in your estate until one spouse passes away, all that capital gains tax wipes away. Remember that stepped up basis. So kick the can down the road, or as Mike pointed out in one of our talks earlier, kick the can down the road. You can avoid capital gains taxes. So 1031 exchanges are huge. Strategy number 3, charitable remainder trust. So this would be for stock. If you have appreciated stock.
Here's the idea with the charitable remainder trust. Let's say you have a rental property or stock that's grown tremendously in value. It's not giving you a lot of liquidity or income. You need more income. You want more income. If you sell that stock to reinvest, well, remember that capital gains tax exposure, it just undercuts the whole idea. So what you do is you take the stock, you put it into this trust. Then after it's in the trust, the stock is sold. Because the remaining assets are going to go to a tax exempt organization, there is no capital gains tax exposure. So if you have a $1 million worth of stock, for example, if you sell it regularly, you're going to lose $300,000 to capital gains tax. So in this context, you sell it, you have $1 million to invest, and maybe you set a 6 or 7% annual rate of return. You get income for life at a rate that you set. And many individuals, by the way, will take that income that they didn't have before, buy a life insurance policy, structure it so that it's not in your trust, and you basically replace the wealth that you might have wanted to go to your kids with a life insurance policy. So
there's a lot of mixing and matching of these strategies that we can use. So we've helped many clients to do this. And frankly, this is how many of our clients who started out as kind of middle class have really risen up by smartly leveraging these rules to avoid capital gains tax. If you're a couple and you have a living trust, there are basically 2 core structures, and we call it 2AB or not 2AB. Many years ago, estate tax laws were much more strict, and we used to have to use what we call an AB structure to provide maximum protection for your estate. Without going into too many details, we no longer need that unless you have a very large estate. In simple plain English, just means when one spouse passes away, the trust splits into an A trust above ground, the surviving spouse's half, and the B trust below ground, the deceased spouse's half. If you did it a long time ago, you might have done it for estate tax purpose. That might not apply anymore. And if you did the AB trust, when someone passes away, everything in their estate gets that stepped up basis. Capital gains taxes vanish. If you have an AB trust, when the second spouse passes away, half of the estate in this B trust will not get a second step up in basis. So if one spouse outlives the other by many years, that can result in hundreds of thousands of dollars in unnecessary capital gains tax exposure. Let's say your spouse passed away a few years ago and you have an AB trust. And you're like, oh, wow, I didn't realize this was a problem. We can actually fix it after someone passes away too. We need to take a fresh look at your trust structure. If you have an AB trust, it may no longer make sense to have that. If you're thinking about selling real estate or appreciated stock, talk to us. If you haven't looked at your trust structure in a while, talk to us. Easy to find us, obviously, Gilfix.com. Property taxes and Prop 19 in California. What do you need to know? Prop 19 is a new law. It's now part of the California state constitution.
Most of us fondly remember and kind of love the legacy of Proposition 13. Jarvis and Gann, the 2 guys who kind of made this happen many years ago, kind of in the 70s. You know, the idea was to roll back property taxes, very small annual increases in property taxes. Then we had Prop 58, which allowed mom and dad to pass along the residence to the kids without any property tax increase, regardless of whether they lived in it or not, and another $1 million in assessed value. That was Prop 58. So all of that is gone, wiped out by Prop 19. So now we have dramatic property tax increases when mom or dad pass away and pass along the property to the kids. So we have first the primary residence. Much information is out there on the net saying that if your kid lives in your residence, makes it his residence, no property tax increase. Absolutely wrong. If your child makes your residence his or her residence, there will be $1 million worth of forgiveness. So in a simple example, if the value of a home is $3 million and your child moves in, the new assessed value is going to be based on $2 million. $1 million is forgiven, but still there could be a $20,000 property tax increase. It's absolutely massive. If it's a rental, vacation home, there's no protection whatsoever. So we're looking at these dramatic property tax increases that in so many cases is going to compel the kid who inherits the house to sell the property.
Very recently, we had a call from a woman named Sarah. She called us because she had inherited a house in Mountain View from her father. She was the only child, and her father literally built the house with his bare hands back in the 70s. The house is worth over $3 million, and he'd owned the house the last 40 years. And so the assessed value, the Prop 13 protected assessed value was extraordinarily low. Let's call it $300,000. But the house was worth $3.3 million. So it was worth over $3 million more than the assessed value. His daughter, Sarah, did not make a lot of money, and she just wanted to keep the house for her family. That's it. Dad passes away. He leaves it to her, and she got a tax bill in the mail a few months later. And it said that her taxes were going up $24,000 per year. So she contacted us to say, hey, is this right? And if it is, what can we do about this? And it was right. And unfortunately, it was too late to really do anything about it. Because if you wait till someone is gone or wait until you've already transferred a house, it's too late. I think she ended up having to sell the house. We couldn't really do much for her in this case. Had we met with her dad before, we could have protected it. We could have kept those taxes low. A $3.3 million home with a $300,000 assessed value. And let's say that someone lives in it. If you can plan ahead and lock in those low property taxes stay at about $3,300 a year in perpetuity after it's inherited or whenever it's transferred. If you don't do the planning, even if a child's living there, $2 million is exposed to a reassessment because again, it's $300,000 plus $1 million is protected if a child's living there. $1.3 million is protected, $2 million unprotected. Taxes go up by about $22,000 a year. Over 10 years, that's $240,000. Over 30 years, that's almost $900,000 in unnecessary extra property taxes. Money that you have to pay in extra property taxes is actually even worse than it looks because you have to earn more in pre-tax money to have after-tax money to pay these. You can only deduct up to $10,000 in state and local taxes from your income. So to pay this extra $900,000 in taxes, the child would have to earn an extra $1.3 million over 30 years to pay this because they have to earn it. It gets hit by income taxes and they have to pay the property taxes. And let's say a child doesn't live in the house, so they don't even get the $1 million in protection. For the same situation, the numbers get even worse. Over 10 years, it's $360,000 in extra property taxes. Over 30 years, it's almost $1.34 million in extra property taxes that have to be paid. So let's say you have a rental property and maybe you have a child with special needs, or maybe you want to leave this. We have some clients who are lucky enough to have a home and a rental, and they want to leave the home to one child and the rental for the other child, just to kind of be fair. Zero protections from reassessment for rental properties, again, unless you plan ahead. Whatever the rental is worth at the time of your passing, if it goes to your kids, and if you don't plan, that's going to be used for a new reassessment. Let's say that a rental property is worth $2 million and the assessed value is only $200,000 because the family's been fortunate to have it for a long time. If they plan ahead and they lock in the low property taxes, well, taxes stay at about $2,200 a year. They go up about 2% a year. They don't plan, property taxes go up to about $22,000 a year. And then they go up from there. So again, over 10 years, that's $216,000. Over 30 years, it's $800,000 in extra property taxes. And in many cases, that makes a rental uneconomical. A lot of rentals in this area, the cash flow is okay, but not great. So then maybe they do a 1031 exchange to get out of it. So we want you just to imagine what's possible when we plan ahead to save your real estate, because we can. But we have developed solutions, and we call it the Gilfix and Leopold Dynasty LLC process. The approach can work to lock in low property taxes for your family. And we use entities and special trusts or a combination of the two. There is no one size fits all approach because there's no one size fits all tax problem. Contact us because we can even layer in asset protection for the next generation. We can keep property taxes low, get the stepped up basis, and protect the property for future generations, sometimes with some protection against lawsuits or divorce, depending on how we structure it. So it's incredibly powerful what we can do. Talk to us if you have these questions, gilfix.com. Estate and gift taxes and the coming cliff. What do you need to know?
What's the current law? This year, an individual can pass along $12.92 million to the next generation without exposure to the punishing 40% estate tax. If you're a married couple, it's double that amount. Another key element now is the annual exclusion. It's the simplest way of transferring money out of your estate. This year, it's $17,000. That's the amount of money you can give to anybody at any time. January 1, 2026, the current levels of protection expire. The legislation that extended that protection sunsets. So at that point in time, the level of protection goes from about 13 million down to about 6.5 million per person. Now, that's still a lot of money, no question about it. But if you own homes around here, if you're a single person, if your estate's around 5 million now, it's going to grow. Property values grow. Your investments, we are optimists. We believe they're going to grow. So at some point in time, you're likely to have an estate that's going to be exposed to the estate tax. And that assumes it stays at 6.5 million. We're looking at this dramatic change in the level of estate tax protection. If you're a couple and your estate is worth maybe 9 or 10 million, again, think about growth. There's going to be exposure. So if there are some pretty straightforward, manageable steps you can take right now to lock in protection, to just be kind of circumspect. Plan for the future. Make sure you're not going to be exposed to this tax.
And keep in mind, life insurance benefits, that's all part of your taxable estate, retirement accounts, savings, investments. So your estate is almost certainly larger than you think.
If you own property in another country, that counts. When we ask somebody what the size of their estate is, if they just kind of think it over, they'll come up with a number. Consistently, they're about 20% too low.
Yeah. What you can do to reduce estate tax exposure if you're worried about this, we want to plan for success. If you have a larger estate, if you're already close to these limits, you definitely need to plan. As we get close to 2026, one simple technique is, well, you max out your exemption, you give it all away. While you're still around, use up that 12.92 million. And then when it drops, okay, well, you don't have any left, but you already used 12.92 million. And it is use it or lose it. If you give away 6 million right before it drops to 6 million, you think, oh, I have 6 million left, so I should be good. No. They will count whatever you've already given away against whatever the new limit is. There's a lot of tools we can use. So Mike already talked about charitable remainder trust. There are spousal lifetime access trusts where one spouse uses his or her exemption, locks it in by creating a trust for their spouse. There's the concept of discounting, which is something when I came into this field, I was like, what? So discounting at a high level, I think this is an important concept. We'll talk about this more in other webinars and videos. But let's say you have a house worth $1 million. If you give away 50% of it, well, that seems like that's $500,000 worth, right? The IRS understands, though, that you can't really sell half of a house, right? That's very complicated. It's tricky. So you get to discount the value of that gift. So if you give away half of a house worth $1 million, you can often get discounts of 20 or 30%, sometimes even more on the value of that gift. So you can give away what really, in essence, can be on paper $500,000 in value, but you only have to use up $350,000 of your estate tax exemption. You made $150,000 basically vanish for estate tax purposes. It's not that simple. Don't quote me on those exact numbers. If you're single and you have an estate in the $4 to $5 million range right now, including your house, we need to talk about this. And if you're a couple in the $8 to $10 million range, we need to start thinking about this. We need to think about the structure of your trust and all these techniques we can use.
So what is the Crummy Trust? Why do I like it so much? Most grandparents are interested in doing something supportive for the grandkids. You set up this trust and you're going to be shifting money into it every year without details. You can't use this $17,000 annual exclusion, giving it away, if it's going to go to an irrevocable trust. It lets us use a technique to cleanse the gift to make sure that we can use, for a couple, the $34,000 annual exclusion to put money into a trust for a grandkid. Now, I generally prefer this to 529 plans, but with the Crummy Trust, you have much more flexibility. Rather than using the money only for education, and you can use the money for education for the kid, you can use it for healthcare. You can use it for housing, much more flexible. Also, as a practical matter, a 529 plan kind of ages out when the kid is done with education. You can set up this trust so that it doesn't terminate until the child is 35 or 40, any age that you pick. Somebody would be the trustee of that trust. Presumptively, it would be one of that kid's parents, your kid. So you're not going to control it. The money's going to be removed from your estate. You're locking in the support for the benefit of that great grandchild. That's why I call it the grandparent's delight.
Laws change all the time, but we already see this coming cliff in 2026. So if you already have a larger estate, talk to us. Mike also wrote a book called Beat Estate Tax Forever. If you are a current client, talk to us. We can give it to you on a discounted basis for meeting with us. We'll usually give you a copy. If you're not a client, you can order it on Amazon, Gilfix.com. Pretty easy to find us, GILFIX.com. We'd love to get the chance to meet with you. If we worked with you in the past and it's been a while, hey, let's set a review meeting and we can help you with all of this and to sort through what issues you need to be aware of. Call us at 650-493-8070. I hope everybody's staying safe, sane, and healthy. Stay tuned for more. Give us a call.